panel. Financial supervision and central banking monetary policy and financial stability functions are greatly driven by data. And today, big data has already offered a wide range of central banking applications, as we have already mentioned in the morning sessions. These are the use of big data in nowcasting and modeling, establishing early warning systems, and driving systemic risk indicators and other areas as well. So as work in big data enters the conventions of central banking, its policy making and supervisory influence is also expanding. That encourages central banks in significant investment in new technologies. And in today's session, we'll have the opportunity to hear best practices of the use of big data in central banks from 4 distinguished speakers. Unfortunately, the panel is just 90 minutes. That's why I immediately want to give the floor to our speakers. But before, let me introduce them. On my left is Mr. Jean-Marc Israel, head of the Analytical Credit and Master Data Division, and he is also co-chairing the working group on Analytical Credit Dataset and the Register of Institutions and Affiliates Data Hub Network, both reporting to the ESCB Statistics Committee. Jean-Marc started his career at Banque de France and worked in 3 different departments: IT, banknotes manufacturing, and external affairs on balance of payment statistics. He moved to the ECB in 1998, where he was the head of division on BOP and other external statistics. On Jean-Marc's left, we have Mr. Bruno Tissot. He's the head of statistics and resource support in the BIS. He is the head of secretariat of the Irving Fisher Committee on Central Bank Statistics. Bruno has been working at the BIS since 2001 as senior economist and secretary to the Markets Committee of Central Banks in the Monetary and Economic Department, and then is the advisor to the general manager and secretary to the BIS Executive Committee. And before joining to the BIS, he worked for the French Ministry of Finance. And on Bruno's left, we have Mr. Giuseppe Bruno. He is the head of support for economics and statistics division in Bank of Italy. Giuseppe joined the bank in 1989, and he was assigned to the econometrics office of the Economic Research Department, where he was responsible for developing procedures for database management and for the estimation and simulation of the bank's quarterly econometric model. In 2000, he was appointed as the head of the Economic Research Department's IT unit. He was in charge of coordinating projects for the introduction of new ICT platforms. And in 2016, very recently, he was given the responsibility of coordinating a multidisciplinary team on big data, which works across departments with different skills. And on far left, we have Mr. Paul Robinson. He's the head of Advanced Analytics Unit of Bank of England. This unit promotes the use of data science methods at the bank, helping to ensure the optimal use of the bank's data to inform policy. The division also works closely with the bank's research hub. He previously worked as an economist in monetary policy area and for 3 years in the bank's Center for Central Banking Studies. Paul took a break from the bank for 3 years. He worked for Barclays Capital as a foreign exchange strategist. So we have 90 minutes, as I mentioned. Let me remind you the format of the panel, although we already know. We'll have 2 rounds of discussion. In the first round, we'll be focusing on the current use of big data in central banks. And in the second round, we'll be discussing the challenges and the future of the big data. So if each speaker can keep his speech 7 to 8 minutes in each round, we can have the chance to have a good Q&A session at the end. So I want to start with Jean-Marc. So what are the use cases in ECB? Can you explain us, Jean-Marc?
Many thanks, Philippine, and many thanks for inviting. Just for being straight to the experience we have, not only at the European Central Bank, but as, in a certain way, part of the network of European system of central banks, so with the national central banks in the euro area. So this morning, Günther spoke about Austria, but the 19 countries in the euro area, but also actually with 27 countries, because what we do in statistics is usually agreed and discussed with all central banks in the EU. I don't speak too much of the UK. The UK has been associated, but not so deeply. Paul will say some more words. But at least the 27 countries for sure are closely associated. So what I will discuss, and Günther alluded many times on it, is what we have as experience. And why do I speak about this ESCB experience, European System of Central Banks experience, is because we have learned a lot from each other on trying to harmonize, trying to coordinate, trying to get the experience, the best practices out of all of these central banks in collecting data and in making them available to users, and making them available to users not only at ECB but also in the national central banks. So it's really the collective experience we have. And I would contain myself to 4 data sets, but there are others which we could discuss. The one which was mentioned this morning very much by Günther was the securities holding statistics. We had a long experience, almost 20 years experience, of building up a centralized security database, so having all the issuance of securities in Europe and a bit beyond, because we have also securities which are issued in the US, Japan and other countries, Turkey and so on, which are held by euro area. So we collect all this data on issuance of securities either issued in Europe or which can be held by the euro area member states. And based on this centralized security database, with again almost 20 years of experience, we have built up a system where we have individual holding, either at sector level, so the banking sector, the insurance sector, the investment funds, etc., or at reporting banking groups, what we call reporting banking groups. So the totality of the portfolio, whatever sub-portfolio, trading or held to maturity, on the banking side. And this is a huge investment, but it's also a huge benefit for users to be able to see. And for instance, when Lehman came, it was too early, we did not have at the time the knowledge and the basis. We had the CSDB, but not all the securities holding. We were just building it up. But obviously, we would have been much quicker in assessing who is exposed, who is actually exposed to Lehman, or the same when there is a crisis, risk, counter risk, and so on, to be knowledgeable about who is exposed. And that helps building up policies which are much more focused and which are not disrupting the market, but just focusing especially to avoid contagion effects. And we are speaking about financial stability. A second example is Anacredit. We have just delivered last month the Anacredit project, so we are now running in production. And over the coming months, we will try to get the data right. We will receive something like 50 million loans in the whole euro area and maybe more in the EU. So it will take some time to get this big data set right, but we are working on the data quality assurance. The IT systems have been delivered. We have a regulation. We have a multiple exchange with the banks. We have even not only a regulation but a manual. And I will come back on the fact that we have even a language, a common language, a business-friendly language under the Bank's Integrated Reporting Dictionary, which was also alluded to this morning by Günther. So for me, it's not only a dictionary, it's a language, it's a business-friendly language, and this is very important because the clearer you are and the more business-friendly you are in your requirements, the more effective you are also, and this is a powerful element of data quality assurance. And the third data set, which I mentioned, is money market statistical reporting. We built up in relatively short time, in 2 years, a system where we can collect everyday transaction on the money market, and the data are available the next morning at 7:30 in the morning. So the banks, 52 banks in the euro area, report directly to the ECB or via the national central banks, and this is powerful because the system was starting in April 2016. In June, we were still in the, let's say, running phase, testing phase of it, and when the Brexit erupted, policymakers could have immediately, the next day, at 8:30, the liquidity committee is at 10, but at 8:30, colleagues could already analyze what had happened and see that, except for, of course, of foreign exchange, all the other markets were quiet. And that has greatly helped at the time to assess what type of measures would have to be taken or not taken, as an example. So it's an example, and we are now building up on this database, because now the ECB has committed to prepare something which will happen in 2019, to have a benchmark rate, because now we can have a benchmark rate, interest rate, on overnight, based on transactions and not only on bids and asks. So I think this is a third example. And the last I would take is EMIR, which was also mentioned. It is not a ECB reporting. The three others are ECB reporting, but EMIR is not. It's a data collection which is about derivatives, and where we make available to our financial stability analysts an extract out of it with indicators which are relevant for financial stability. So it's an external example, but it shows that big data can be very much helpful in several respects, even if we don't build up, but if we, let's say, try to make it as a pool, as a pooling of data. What are the conditions for this to happen? Is, of course, to have harmonization. I think this morning was mentioned in particular the risk of machine learning. Machine learning can be extremely powerful, but it is also risky. And a way to go into the direction of, let's say, better mitigating risk of machine learning is to have this supervised approach. That is to say, we try to see and test with real data. We put the knowledge of experts and we test how the machine learning works, and we refine it. And this machine learning on a supervised basis is much more powerful. It's not necessarily immune of any risk, but it's much less risky than the non-supervised. Non-supervised can also be helpful, for instance, with unstructured data or with when you have less expert knowledge, but it is more risky, and you should use it with having this risk in mind. So that is one. The second element is this language. I mentioned the word, and it is very important to have this endeavor, which we have jointly with the commercial banks, where we mutualize the knowledge. So we start from the definitions which are in regulations or in international manuals, and we go to the level of individual transaction, individual operations of banks or others in the industry, and try to make it a common language, a common understanding on how to translate this for reporting. But it has a more important than that. It's not only for the reporting, because banks express the view that even for their internal systems, for their internal reporting to their executive, they benefit from this clarity. So I think it's not only something which is between the commercial banks or the financial industry and the central banks or the supervisors, it's also even useful for the banks to have a common language in particular. The third probably pillar for it is a register. We have a common register in Europe where we build up a knowledge about who is who, and individual identification. This is called RIAL. We publish some extract of it. We don't publish the register itself, but having put in common this knowledge enables to have identification of individual entities. The length is inferior to here, but for instance, there are 2 million entities in clay worldwide, whereas in RIAL we have 7.5 million entities only for Europe. So you see that there is a kind of different demography, and we really benefit from it. But not only the individual identification, avoiding duplicates across countries, but also the group's structure, which is essential for risk management, collateral management, financial stability, and so on. And of course, supervision, resolution of banks, etc., because you need to know who is who. So these are basic pillars for producing granular data and to have, let's say, a common view. And we have built up basically for banks, because banks is, of course, a key focus for central banks, but we have the title of fintech, and in principle, granular data collection is also much more powerful for fintech, because if you aggregate data, it's a transformation rule which is not necessarily easy for the industry. Whereas if you go more granular, you have less complexity in transformation rules. You have still some transformation rules, but still basic. And I give an example. We have built up recently, and the data will come next year, with pension funds. And the pension fund industry is an industry which is very specific, which is not very much supervised, or has not been so much supervised so far, which is not very regulator friendly. But we have built up with a thorough discussion with industry a system which is really granular and which was welcomed by them. The same with investment funds and others. So I think it goes beyond the banks, and it goes with the financial industry. Second point, just overall, so that was the data question. A very important point, and we will not be long on this. What is important is that we compile in common, and we have rules for compiling which can use machine learning, but again, on the supervised basis. I will not say much more unless you have questions, but machine learning can help in assessing patterns, in assessing outlier detection, etc. So I think we can learn and benefit from it for these very large data sets in millions of entities. And last very important element is that we don't collect the data for the pleasure, we do it for serving users. And dissemination is very important, and we try to assess a level of access to the data with powerful users who have access to granular data and know what are also the pitfalls, because there are pitfalls in the data, and they need to be knowledgeable. They need also to be very, very knowledgeable about confidentiality issues, and they help us. But then we can create dynamically, with agility and flexibility, a new data set, new dimensions, and go backwards, because that is also a very nice feature of granular data, is that you can also rebuild backwards aggregates. And I think that is something which also the crisis has shown that some breakdowns, if you start collecting data, it takes 3 to 5 years to build up a system, and then when you build up a system, the users cannot use it because they don't have time series. So I think this is very frustrating. Whereas with granular data, you stabilize your reporting so that minimize the cost for reporting agents, and at the same time you serve the users, because if they say I need this aggregate, you can also give them at least 3, 5, 6 years of backward data, which of course is very helpful. So overall it's a dialogue with industry, which is a key requisite, but also a requisite for them also to be able to use the data. Thank you.
Unlike any other national banks, standardization is key, and you pursue very important governance rules. Thank you for sharing your experience. So let us broaden our perspective and turn to Bruno Tissot, since BIS covers a wide range of central bank practices. How do you see, Bruno, the use of big data in financial stability monitoring within BIS central banks?
Thank you very much, Kelvin. First of all, thank you very much for inviting me. Second, congratulations to the organizers. Very well organized, very interesting, especially the Toronto Center, the Central Bank of Turkey, and in particular the statistical department, because you are really leading the work among central bank statisticians, so congratulations. So, what can I say, both from a perspective at the BIS as compilers of statistics, and also as an IFC committee, where we try to share experience among central banks on statistics. I would like to have 3 points. What is big data for central banks? Second, what do we do? What are the applications? And what are the best practices, if I may call them like this, but a few thoughts. But first, what is big data? 5 years ago, people would have said, well, it's simple, big data is just the Internet of Things. Google searches, etc. I think it has changed a lot over the last 5 years, especially among central banks. First, Google searches, yeah, still used, but for example, you have the very good example of the flu. So at some point, people were a little bit disappointed looking at Google search to do some nowcasting exercise. On the compilation side, also people were thinking, oh, we go on the internet and we collect all the information. A recent estimate for the US CPI shows that 15% of the US CPI is somehow derived from the Internet of Things. But people were expecting much more, and basically it's not expanding more. Of true, it depends whether you are in an advanced economy or in a developing economy. In a developing economy, where sometimes you don't have a lot of good statistics, it's perhaps easier to go to the internet and to create CPI or house price indices derived from the internet. But for advanced economies, it's still a bit more difficult to say that the Internet of Things is really the big thing right now. So what is really the big data for central banks? I would say that on the internet, what has really come is all these text mining techniques. So you collect text and you can use this text in a very automatized way. But then you have a lot of data sets that are not from the internet and that are becoming very relevant for central banks. We mentioned this morning, and you mentioned this again, Jean-Marc, but financial data. Do we make the most of our financial markets data sets that are available, for example, tick by tick data, you know, minutes by minutes? I know that the Central Bank of Japan, they are looking at this data to monitor the liquidity in the government bond markets. So we do a lot of work, and we have a lot of work to be done on the financial markets data sets. Then the commercial data sets. The thing that is exploding in recent years is not the salaries of statisticians in central banks, but it is the amount we pay to the commercial data providers. At least at the BIS, we spend a lot of money to buy all these new data sets that are coming from commercial data providers. You know all of them, Bloomberg, etc. So we are just at the beginning of making use of these huge data sets. And of course, and I think it's even most important for central banks, what we would call administrative data sets, what you were suggesting, the credit registers, tax registers, etc. So loan by loan, security by security, derivative statistics, all this kind of information. So to summarize, financial big data is not just the Internet of Things. Internet of Things is important, but you also have a lot of pure financial market data sets, very complex, very large, commercial data sets that we need to make use of, and of course the new revolution right now, making use of the administrative data sets that were already existing 20 years ago, but we were not making use of them. So this is the feedback that I have from central banks when they mention what is financial big data. A few minutes on what are the applications that we see. I think we have 5 types of applications. One is, of course, you can go micro. You can go very deep into the data to look at what is important for the system because it's relevant because of financial stability analysis, for example. So, for example, you have this network analysis. You are able also to look at the contribution of a very specific participant in the financial markets. So it's obvious because we have a huge amount of data, very granular. We can go deeper, we can go micro, we can look at really where you want to analyze things. The second thing is that we are able to compute more distribution indicators. And it's not just central banks, it's also when you speak to national statistical offices, they really feel that we need to have more distribution indicators. If you look at household debt in general, it's not sufficient. Household debt is different whether if it's very rich people having debt or if it's people that are poor and they are taking debt because they need to consume. So going beyond the aggregates is a second key application. The 3 major applications, of course, and especially for the national statistical offices, but also for the central banks, especially because central banks are, in most of the countries, compiling the financial accounts. When you use all these micro data sets, these very big data sets, you can have better aggregates. So, for example, there is a big initiative right now to compute financial accounts in many countries in the world. I know Central Bank of Turkey is doing this. And to compute financial accounts from room to room tables, so you know who is owning what and as is lending to someone else, you need to have very granular information, and really it does help to compute this It's just an example, but we have a lot of other compilation exercises. The fourth application is policy evaluation. So, and this is because after the crisis, you have much more policies willing to look at very specific and granular information. A good example is macroprudential policies. Macroprudential policies, they don't look only at national aggregates, they want to look at a very specific type of debt, like mortgage debt. They want to look at very specific types of people taking debt, like first issuer of mortgages, or they want to look at very specific types of instruments, for example, interest rates that are constant or not in terms of bonds. And I was told that in some countries, macroprudential authorities are even looking at zip code, so having different policies depending on the zip code of where the households are. So it tells you a lot of the kind of granularity that we want to have. And the last point that I like very much is that because we have all this new data, as Jean-Marc was saying, we can reallocate the data, we can play a little bit with the data and find something new. And a good example is what we do at the BIS, where we publish international debt security. So we collect granular security by security, and we publish debt security issuance for all countries in the world on a residency basis. All the residents in the country issuing debt. But because it's granular, we can reallocate and say that each security is perhaps not from a national of the country. It's just from a resident that is controlled by a national that is outside of the country. So we are able, because we can reallocate all this security one by one, to have, for example, the issuance of Turkish residents and the issuance of Turkish nationals in our statistics. You may think, well, it's an interesting exercise. No, it's a very important exercise because debt issuance has been going up very importantly in the last 2 decades for emerging market economies, and most of this increase has been in offshore centers. So if you look only at debt issuance of, for example, advanced economies, you miss all what is issued in offshore centers by affiliates that are controlled by your residents. So applications, to simplify, going macro, having distribution indicators, having better macro data when you compile them, being able to do policy evaluation, and also having new insights because you have new types of data. And then I finish with this. You wanted to have implication in terms of best practice. What comes from the central bank is that you have to be pragmatic, so you cannot reinvent the wheel, you have to think small, you have to have projects, but at the same time you have to be ambitious. So it's not just buying the new Hadoop tool, it's not or buying the new computers. You also have to rethink your information system. So you have to be pragmatic, at the same time ambitious, and the way to do this, I think, is to share experience. So this was said for the ECB, but at the BIS and the IFC, we promote a lot of sharing of experience on big data issue, because if the central bank is doing this alone, it will take much more time than if you have a collective work. Thank you very much.
Thank you, Bruno. So we see a widespread of the use of big data, and not only amongst the central banks, but also nation-state offices, private sector. So new norms of measurement is in place with the use of big data. You also mentioned the best practices, and we have 2 lead central banks now. One is Bank of Italy, where Giuseppe is in charge of leading these teams. So let's hear one of the best practices.
Okay, so thank you very much for inviting me, and of course I would like to join Bruno in thanking the Central Bank of Turkey for the impeccable organization of the meeting. Now let's try to go on this big data and machine learning, artificial intelligence issue. So we started this travel, I would say, about 3 years ago, and it was the beginning of 2016, and we were just trying to answering, if I remember, we were answering a questionnaire that was issued by the BIS about our interest, about the project that we are going to start. Then we had an another very nice experience attending a meeting in September at the Riksbank, Sveriges central bank. And from then we started our sort of strategy that is based essentially on cooperation between different skills inside the bank. So not just statisticians, but economists from outside, but computer scientists and mathematicians. I would say mathematicians start to play their roles even in central banks. And also considering the data that we are taking into account, first of all, using a lot of microdata from different surveys and statistics, but also one thing that is relevant to us is social media. So we started with Twitter. We are going to go further with other platforms like Facebook, and also with other say newspaper digital format, just to take into account what Bruno was saying about text data, because on the web, I mean, 4/5 or even more of the amount of information that is available is in text format. So if we are able to take advantage of this, we could improve much of our jobs. And also this morning we were listening about subtech applications. I think one of the most important would be the possibility to read immediately the statement released by banks or by companies, trying to understand whether there are signals of fragility, of brittleness on the financial issues. Then going to the applications. So we have started some applications on, for example, from social medias, trying to extract the sentiment, the feeling about particular banks, and we have done this job especially in 2017 when we had 4 banks, sort of middle banks troubles with the final resolution, and from there we started collecting tweets that were talking about these banks, and we have been able to find correlations between the variation of deposits and the feeling of the people. We also used Twitter to try to get another complementary estimate for inflation and for unemployment. So that's the kind of things that I think is important. So the use of this big data, not just for statistical application, but also to get a glimpse on the classical figures that are used by policymakers, like inflation and unemployment. Moreover, we also started working on different and new technologies, say machine learning technology, and in particular neural networks, trying to understand better time series evolution using these universal approximators, as they are called. And for example, we started using data from payment system. This morning we have heard about using single data payment from in the interbank market from Target 2, and we have applied some neural networks technology trying to nowcast say, outliers or anomalies in the payment system. Also, we use these techniques, so we are experimenting these techniques also for nowcasting on macroeconomic variables like GDP or inflation, using this sort of mathematical techniques that are of course compute intensive, I would say. And finally, we are also starting to take into account other machine learning techniques called reinforced learning, trying to study behavior of people in auctions, trying to understand whether it's possible to find early signals of collusion among people participating in monetary market operation. And so this is the general application that we have been facing. And I would like to say that I fully agree with Bruno about the cooperation, because for a central bank that even if they are able to hire the brightest people, they will never be, it's never possible to compare with a giant like Google, like Facebook, that are able to recruit the best people right at the university. So even without waiting for their degree, so they just are able to find the right people immediately, and they hire them. So we, as central people of central banks, should be considered that the sharing of information, and like this occasion, is helpful in trying to find and to elicit best practices, even in the confrontation and the discussion. So that's why I think it's very useful. And for that, we are at the Bank of Italy, we are having an annual meeting. So we had one in March last year, and we are going to have another one in June next year, where we present our work and we expose it to the critics. Also, we are having another meeting in January, the middle of January, where we are going to share views about computing platforms. So we have spoken this morning about their relevant role in enabling the research and results for this big data application. So we are going to have this meeting to share and to receive critiques from the other participants. Okay. Thank you.
Thank you, Giuseppe. So you mentioned that multidisciplinary team is required to handle these new techniques, and these new techniques lead us new data sets that has not existed before. So Bank of England also pursues a new business model. They established a data governance group as well as a data lab and an advanced analytics unit where Paul is responsible. So they have already taken these institutional steps towards this new business model. So let's hear, Paul, about your experience.
Thank you very much. Thank you for inviting me. Thank you for organising it. To repeat what's already been said, I think that international cooperation on these issues is incredibly valuable. We all have a lot to learn from each other. And I would add international cooperation is just a good thing in itself as well. I think that the previous speakers have done a really good job in setting up a kind of good structure to think about this. So I'm not going to spend any time discussing what big data is or isn't. What I will do is slightly separate the data, though, from the analytical techniques that we might use to interrogate it. So I'll start by talking a little bit about some of the big-ish, shall I say, data sets and what we've been doing with them in a few explicit examples. And then I'll talk a little bit about machine learning and our experience of using that in a central banking context, which I think does differ quite significantly from the use of machine learning in companies such as Amazon, Google, etc. So the first example I was going to use is really with big data as a very granular source of information. So Bruno mentioned that one of the uses we can make is to better understand the distribution of things and also to get right down into the granular information. Now, we used this a few years ago now, initially, back in 2014, to try to understand what was going on in the UK housing market. At that period, house prices were growing pretty quickly in the UK. Turnover was still relatively modest, but nonetheless, the experience of Britain and housing market bubbles has been at times quite painful over the past few decades. So this was something that was really high up on the policymakers' list of concerns. Fortunately, our sister organisation, the Financial Conduct Authority, which regulates owner-occupied mortgages in the UK, actually now gets every single mortgage that is given to someone who's going to live in the house that they buy, which is an incredibly detailed data set and very useful. So using that, what we could do was to produce a map of various measures, but one in particular that was of high policy relevance was the loan-to-income ratio. What we were interested in was areas of the country where a lot of mortgages were being given with a high loan relative to the size of the person's income, the size of the borrower's income, in particular whether they were over 4.5 times the income or not. And what we found was that even though the aggregate statistics suggested that the UK housing market was booming in some sense, house price inflation picking up, it was incredibly geographically heterogeneous. And in particular, if you went into London, there was a lot of evidence of a seriously hot housing market. But effectively, once you moved outside London, and particularly outside the southeast of England, which is dominated by London, this just wasn't true. So my parents, for example, at that point were trying to sell a house in North Wales and couldn't. So it just was not a national phenomenon. And by being able to look at this, we could even see within London there were big differences. So areas such as Kensington and Chelsea, which is very affluent, has a lot of money flowing in from abroad, had a very hot housing market. Basildon, which isn't very far away geographically, had a much cooler housing market. So by understanding what was going on, we were able to inform the policymakers, in this case the Financial Policy Committee, and as a result of that, together with an awful lot of other analysis, they put in place actually, up to that point, an unprecedented policy measure, partly driven by our understanding of what was going on in the housing market, which was driven by having granular data. A second example of better understanding what was going on in the distribution is we looked at the liquidity of sterling futures, long gilt futures market. Now, most of the time when people look at liquidity, what they do is they take things like bid-ask spreads and say a small bid-ask spread means very liquid, a large bid-ask spread means illiquid, which is true as far as it goes, but somewhat can hide a multitude of sins. So what we did was we used the whole order book. So the whole order book not only tells you the marginal prices, it gives you the whole distribution of orders. So for example, you might have very tight spread, but very, very little buying and selling at that price, or even more dangerously, very little on one side of that price. And so by using this, what we could understand much better is actually what was happening in a very important financial market. And we could, because we had a time series of this data, we could hone in on particularly interesting moments, one of which was the Brexit referendum, which was obviously a major event in financial markets in general, but particularly major event for UK financial markets. We could actually examine the way that liquidity changed during this period. So liquidity did dry up to some extent, but very briefly, and actually came back really fairly quickly into that particular market. Along the same sort of lines, we've done a lot of work using the EMEA databases. Now, there was a really nice quote earlier today, which was, we all want to be in heaven, but none of us wants to die. I have to say, using the trade repository data sets on the derivatives transactions, it's got so much information, so much potential. Heaven is in there. Working with it at times felt a little bit like dying. It's a lot of work. There's a lot of inconsistencies in the data. We only see a partial view of the market. So there are significant challenges. We had quite a lot of computing challenges using it as well. What we did do, though, was there was a fantastic natural experiment, which is the Swiss National Bank's decision to stop imposing the Swiss euro exchange rate floor, which came completely out of the blue. It was genuinely a surprise to the market. We knew exactly when it happened. We knew that in that particular market, the Swiss franc market, it was by far and away, overwhelmingly, the most important event of that moment. So what we could then do is to look at the network formed by derivatives contracts using Swiss franc derivatives, and so just see what happened. To what extent does a big shock like that leads to a fracturing of the network of financial exposures? And what we did find, actually, what did lead to really a quite significant move. It's a very complicated data set. I'll refer you to Financial Stability Working Paper for more details. But it was an example of something we just simply could not have done 10 years ago prior to the EMEA regulation. One final thing, which has also been mentioned, is there's a lot of interest in text analytics. An incredible amount of interest, actually, I'd say, in text analytics. And it can be used in all kinds of different ways. So, for example, one way we used it was to see if there were any warning signs about panic around the Scottish referendum. So, there's been a few referenda in the UK recently, but one back in 2015 or 2014, I think it was whether Scotland would leave the UK. And we used Twitter to see if there are any worries about Scottish financial institutions, because it led to various questions about the lender of last resort. Fortunately, there were no obvious worries, but again, this is something that we previously probably couldn't have done. But a more interesting, in some ways, piece of text analytics we did, we actually looked at our communications. In particular, what we looked at was the letters that we as an institution sent to the companies that we regulate. So every year, we have a big review of each individual institution that we regulate, and we send them a letter which explains our thinking, highlights any worries that we've had, all of this sort of stuff. So we looked at whether there were any systematic differences in the language that we used, the complexity of the letter, the length, the amount of kind of telling them what to do rather than asking them what to do, that sort of thing, depending on how large the company was and how far from resolution, i.e. how safe we thought it was. And we could also do this on a time series basis, so had our language changed in the way we speak to the companies we regulate in light of the financial crisis, for example. What we found was there were differences. So we spoke, or we wrote, systematically differently, on average, to larger companies and to companies that we deemed to be safer. And there had been a significant difference in the way that we wrote to companies prior to the financial crisis, which was done by the Financial Services Authority. In those days, the Bank of England wasn't responsible for this, to more recent times. So again, something that is got a lot of interest, and there's a working paper which explains that. Finally, a few things about machine learning. Jean-Marc mentioned that there's both supervised learning and unsupervised learning. I think both are extremely useful for central banks. But in both cases, we do run into problems. as central bankers. One in particular, which I think is a really important issue, is the so-called Lucas critique. So what machine learning and big data more generally is very good at is understanding patterns in existing data. But what happens if that existing data is not representative of the thing you care about? So for example, the future. In particular, to get back to the Lucas critique, what happens if we make a policy that changes the relationship between different statistical variables? In that case, machine learning can be positively harmful. I don't know if any of you have ever estimated an error correction mechanism, econometrics model. What that does, it says, here's an equilibrium, and we always want to get back towards that equilibrium. But if that equilibrium shifts, those models do really badly. And machine learning is potentially vulnerable to that. So one of the things we're really trying to work hard on is to improve our ability to give some context to machine learning results. In particular, what are the variables that are really driving things? And can you partition those over across time, across different events, to better understand what often is just a black box depiction of statistical relationships. And then finally, on this, let me just mention a piece of work actually we've done in the monetary policy area, which I think is very interesting from a statistical perspective. So what we've done there is we've looked at the text that is included with vacancies, so job vacancy adverts. And what we found, what we're trying to do is understand better vacancies, but we're also trying to understand the nature of jobs. So a computer programmer today is a very different beast from a computer programmer back in 1960. Back then, it was effectively unskilled labour. Now, you work for DeepMind as a computer programmer, you get a lot of money. It's a very skilled job. So things have changed, but the name computer programmer has remained constant. So what we were looking at was mapping the language used in vacancy adverts onto the statistical categories in the labour market and see how that has changed. So for example, project manager is part of an awful lot of different types of job, whereas school teacher is a school teacher. There's a very limited number of jobs that you can use. And by doing this, what we can see is the way the labour market is changing over time, the way the vacancies interact with other labour market measures such as wages, unemployment, size of the labour force, etc. over time. And again, we can only really do that using machine learning techniques, text analytic techniques, and very detailed granular data. So that's just a few examples of what we've been looking at. There are many more if you're interested. But that's it. Thank you.
Thank you, Paul. So thank you for sharing your experience with very interesting cases. So we see the light at the end of the tunnel, and we think it's heaven, but we are in the dark tunnel, and it's a long, bumpy road. So let's discuss more about the challenges of the tunnel. In the second round, and the solutions and the future of big data in our central banking policy. So obviously, like heaven. So we can start with Jean-Marc, the second tour.
Many thanks. Yeah. Indeed, I think what has been said earlier, and especially by also colleagues, is that we are already on the way. It's not something that will be discovered from now on. And this element of sharing data, but sharing also information, knowledge, and best practices is essential across central banks, across supervisors, statistical institute, and others. Because I think we have part of the knowledge, but we cannot afford having part of all the skills which are necessary. So I think this element of exchanging and discussing is absolutely essential. I would develop 4 or 5 points. First is fintech, and we are here about the conference on fintech, and more generally digitalization implies a dialogue, an increasing dialogue between the industry, the reporting agents, the industry in general, and the supervisors, the regulators, because we need to understand what is going on with the business, and only the business know that. We need to have a language, a common language, so that we can mentioned very much the element of classification, about standardization, etc. If we don't have common definitions, we can go everywhere and certainly misinterpret or have a missed dialogue. So I think this element of having a common language, having a common view on definitions, having a common view on what is what and how to classify entities, how to classify instruments, etc., is very important. There is work at the BIS and in several committees about this. Work is maybe not getting close enough and quick enough, but still it is on the way. But very important is that we have this dialogue with industry so that we can use standards, that we can use things which enable to know exactly what we design. And we know that in a world of fake news and uncertainty, it's all the more important that we can at least avoid, let's say, missed dialogue, because simply we are not being precise enough on what we design. And this is element, also regulators, and that was said very much in the first panel, regulators need to intervene not too fast, not too deep, until there is an obvious need, but they should also not wait too much. If we are not too late, it's not good as well. So I think to find out the right balance is all the more important, and having this dialogue with the market, making market intelligence, and making also aware of the data we have and giving a feedback to the industry is essential to this dialogue. That's the first thing. The second thing is there are risks. And there are risks which are very different: cyber risk, operational risk, even loss of sovereignty. When we speak about cloud, the cloud at the moment is only in two big areas, China and US. That means that Europe, for the time being, and maybe many other countries here in Turkey, in Africa, etc., are completely out of the cloud. That means that when you refer to the cloud, you have risk on your data, because the legislation about protection of data is not the same everywhere. You have risk about your dependency. If there is a commercial trade war or anything like this, you are in a weak position. And I think this is something that we cannot ignore. And we need to mitigate this risk. So I think, and for instance in the EU, we have now a new legislation about GDPR, so meaning the protection of natural persons in terms of the use of the data. And we know that the situation is completely different in China, where there is absolutely no protection, and everybody is aware. And in the US, where it is a bit closer to Europe, but still data can be used for commercial purposes, which is not necessarily so obvious in Europe. So I think we see very, very closely what means digitalization and the risks which are embedded into digitalization, which doesn't mean that we should not benefit and we should not let the market develop. It should. But on the other hand, we should not ignore the risks which are associated to it. The third, and maybe the most important point, is we are in societies where data have become ever more important. It's almost now the main source of, let's say, decision making, of sharing information, etc. You need to have access to data, you need to share data, and that means that decisions are still arbitrary and subjective, but the more you can base your decisions on data, the better it is, because there is a need for more transparency, for more accountability, and data-driven decisions, even if the decisions are not only data-driven, let's be clear, but at the same time, if you can base your decision and you can explain your decision on data, it's always better, because data can be facts. But on the other hand, it was said also that statistics lie, and more than lies. So it's, you know that there are statistics or data which are erroneous, or which may even lead to misinterpretation. That is a difficulty. But on the other hand, statistics, when they are official and when they are very well established, with a certain number of governance elements, which you mentioned, about advertising in advance, when you release the data, when you protect from government interaction, etc., statistics can be the best way to establish facts in societies which are increasingly complex and difficult to understand. So having the advantage of granular data, you can really go and drill down, that was explained very much by Bruno, by Paul, that you can drill down from the aggregates, and your human brain will only be able to tackle aggregates, even if you have tools to go down, but to drill down whenever you need. And I think examples were given. I gave example with Sarah, other examples were given, and I can give another example, which is when the crisis erupted, there was a big question because on one hand, the lending survey, credit lending survey said banks are tightening very steeply their standards, and at the same time, the credit aggregates continue to grow. And at the time, we did not have a survey, but the survey ex post showed that it is because the enterprises were drilling from their credit lines, and the use of credit lines went up from 70% up to 105%. So even beyond what the credit lines were, and that explained why the credit aggregates continue to grow, why the tightening was also very effective. And this is an example, and it was not also the same for all banks in all countries. So I think if this element of dispersion is absolutely key, because you have better understand what is going on and how to analyze what is going on. And again, granularity means flexibility, agility, lower cost, because of course there is a one-off cost to build up the system. But on the hand, afterwards, the system is stable, and for systems which are highly automated, the less you maintain them, the less cost you have. So it's a one-off cost, but in our dialogue with the banks and with the financial industry, it was recognized that this element of stability, this element of better interpretation of the requirements, because we had also in the past a lot of misunderstanding about aggregate reporting where there were misinterpretation. So this element of correct interpretation, of dialogue, and especially of return on initial investment, but return on investment, thanks to the stability of the time. Return on the fact that we can give a feedback, but there is a benchmarking by the industry, but they can also use the data, for example, credit data on their own creditworthiness assessment or credit risk assessment of their counterparts, etc. All this element is extremely important in terms of changing the return on investment. And also for research purposes, when you go granular, for instance, for the first time with an accredit, we will have, and there was only one country which had it was Portugal, but for the first time we will have interest rates. So we will know what interest is served, what is the conditions under which the banks are maybe profitable or less profitable, what are the funding stress on some of the banks or some of the countries, etc. So to have comparison and much more efficient macro-prudential and micro-prudential analysis of the situation. So these are examples. So all this means new dimensions of the study and a better understanding. That means also that users have to be an effort, because sometimes definitions may differ for good reasons, because macroeconomic and macroprudential analysis, etc. So we need to also have a common language, and the effort of this common language is not for free. But on the hand, if we share this knowledge, if we share the discussion we have and how we have made it happen, I think that can be a common good of central bankers, but also supervisors, offices, etc., statistical offices, etc., to really bring together this knowledge and benefit from it. Last but one point is precisely this element of pluridisciplinarity. I think when we see what we are doing and that we try to address the different concepts, it's difficult. For instance, on macroeconomic, the standard is national accounts, is SNA, and SNA means residency-based, original maturity, for instance, whereas when you go from microprudential and macroprudential, the standard is residual maturity, it is consolidation, etc. And you know very well the BIS what I mean. This is not easy, and only granularity enables you to reveal the aggregation in different ways with different underlying concepts. So I think it's also an element that all our users, monetary policy, risk management, but also macroprudential, microprudential, etc., want to have also a certain knowledge about why the data are differing. They are differing for good reasons, but if we can give them the reasons why they are differing, they are on a safe ground to interpret. Otherwise, they are not. And I think this is a key element about why granularity is so important in the world of central banks, but also financial stability, microprudential supervision, and so on, that you can give grounds how to warn or to give caveats about different pictures which are not necessarily inconsistent, but which need to be understood from a methodological point of view. And that is a very difficult challenge, but also a difficult challenge that we are overcoming precisely because we can give users knowledge about what is going on. That means also new skills, I think that was mentioned, machine learning, etc. is really important. We should be careful using it, but it's absolutely indispensable. So it's new skills, it's new organization as well, because the interaction is stronger between those who are compiling the data and those who are using the data, and that means that there is really pluridisciplinarity and combination of the knowledge between the people, and dialogue, structured definitions. So a lot of methodological work in the background, also on master data, so I mentioned real, also on the methodological aspects, again, with this complexity of different models, conceptual model behind the data. And all this means that we will work differently in the central banking in the future than we used to, because precisely this pluridisciplinarity doesn't mean that people will all do everything, but at least that there is a need for combining the knowledge, skills at different level and across different departments. And also, this is a key point, that there is a feedback to markets, and the feedback to markets is by dissemination of the data, by dissemination of elements which enable the banks to assess better their credit worthiness, or banks and the industry, financial tech, etc. And so on. So it's also having a more osmosis between what the regulators and supervisors do and what the markets perceive from it. And last point, whether we will increase the financial stability is to be seen. What we can do, and I think it was said very much this morning about contagion effect, about interconnectedness, etc. The complexity of the data is also, if at all, be solved by this more granularity, because you can rebuild any type of interaction between entities and knowing, for instance, who is exposed to whom and so on. So I think this element of financial stability is very important and can only be tackled by this integration of data, by this granularity, and better convergence into the techniques which are used to collect data. So now, whether this will lead to more financial inclusion is to be seen. I was in a conference last week where there are risks. I mean, the societies are now in dichotomy between both the having and the have-nots, and it's not clear. And even if this morning it was mentioned that the financial inclusion may be, in particular for women, an advantage, women in certain countries, I am not sure, because there will be a dichotomy between access to these models, to this knowledge, and to the ability of growing the maximum out of it, and those who have not. And I think we see, especially in France right now, that this inequality in the countries is growing and is extremely dangerous. So I think there are risks of disruption, and responsibility is to avoid this dichotomy and see how to, let's say, really lead to financial inclusion within countries and across countries as a whole. So that's one. And the second is financial sustainability or sustainable finance. I think it is also a challenge, and certainly what we have discussed earlier about better knowledge on who is financing whom. I mean, the Norwegian, for instance, Sovereignty Fund is doing a lot about sustainable finance. There is a lot in the detail about it, and the more we know about how credit goes in different formats to the economy, about increasing competitiveness, about more sustainable development, etc. I think all this is also a big challenge, and I think whether fintech or classical financial industry, we need to have the tools, and certainly here too, things like granular data enable to answer a number of questions, because the criteria are not clear, they may change over time, and being able to adapt to the criteria is absolutely key. Thank you.
Okay, thank you, Jean-Marc. There are really big challenges that we have to face, and having a common language is one of the key issues that we have to set. And there is a big role to international institutions on that front, I think, and BIS is one of them. So, Bruno, how do you see the challenges of big data and the role of
Okay, a lot has been said. What can I say more? Challenges, I would say, regarding the data, regarding the handling of the data and using of the data. First, regarding the data. So these data are very complex. They are fund data. They are not produced for a statistical purpose. So we need to make use of this data to transfer them in statistics. It's a good example, this trade repositories data you were mentioning. So we have a report of the IFC where we looked at all the countries in the world, what they are doing with these derivative statistics. It's big data. It's 100 million of observation every day. So it's big data, and basically central banks are saying it's huge difficulty in terms of compiling the data, quality assurance, identifiers, identifying the granular information is a challenge. Another issue with this data is that they are not always accurate. So we should have in mind that it's not because you have a very big data set covering, I don't know, 80% of the population of the US, that by definition this data set is accurate. You still have a bias, and you still have, sometimes when you compare these exhaustive data sets with survey data sets that are really done in a statistical perspective with good, in order to deal with the bias of the sample, sometimes the survey is much better than the exhaustive data set. So we need to be aware of the degree of accuracy of the data sets. And the last thing on the data is time dependency. Twitter, you use Twitter at the Bank of Italy, but perhaps in 20 years, Twitter will not exist. Or another issue with time dependency is, as you said, because it's not like for the statistical office that are looking at satellites images, there will be forever, at least for the next 2 decades. But in the financial markets, the purpose of the policy is exactly to change the behaviors in the financial market. So the data have to change by definition because you expect an action on the financial markets. And perhaps on this time dependency, a point that was mentioned this morning is that we firmly believe at the BIS that when you look at tensions or indicators of crisis, sometimes if you look too micro, you may be lost in the details. So sometimes you have to look at very gross indicators like credit to GDP, and then when you see that there is a problem, then you can look deeper in the micro data. But before a crisis, you may be more willing to look at macro statistics. After a crisis, you may be more willing to look at very detailed data sets. So there is a discrepancy before and after a crisis. So these are the challenges with the data. Rapidly challenge with handling with the data. We have mentioned the cost, the security for us is a key issue. But I would like to say that perhaps the most important is that people are giving the data to national authorities somehow. So the reputation, the trust in the central banks is very important. And this is even more important as people do not realize that the data are passed for something else. Julian Tett at the IMF was saying, we should not say it's big data, we should say it's a big gift. People are giving the data for free without knowing why. And I think this, the fact that we are the repository of data that are given to banks, etc., and then to central banks, puts a premium on the reputation and the trust in central banks, and for example, the BIS in handling with these data sets. So we, for example, at the BIS, we spend quite a lot of time to protect and be sure of the confidentiality of the data sets. And then there are the challenges with using the data sets. I would say one is communication. As was said this morning, you need to be transparent when you are a policy maker. And if you come back and you say, oh, I raised interest rates because Twitter was giving this signal yesterday, you may have an issue. You have to go beyond the black box. You have to explain why you take this decision. And then another issue for using this big data is that is perhaps, but we will see, is that you are always looking at the new indicators. So there's a push to look at very short-term indicators reacting to news. And we know as central banks that we need to also have a very long-term view of the financial cycle and how things are evolving. So this is a key risk, but hopefully there is not just challenges, there is also a lot of opportunities.
Okay. Thank you, Bruno. Giuseppe, what will you be adding to the challenges plus solutions? Maybe you can also discuss some of the solutions as well.
Yes, well, I have 2 points that are related with what been already said by Mark and Bruno. And so the 2 points that I raised is about personal data, so like personal preferences essentially, and security, that are somewhat related. So in this time of big data, most of our personal data about our age, about our gender, about sometimes sometimes even about our health status are shared in different platforms. So this of course puts big threats, especially for central banking institutions because of their reputation that they have to defend. But problem is that these data are given also to other actors, like we can think of Amazon, we can think of for example, a bookstore, because they know our preferences and our tastes, and they provide advice to us even when we don't ask them. So this is something that we have to take into account first of all, in protecting the data when we are dealing with them as a central institution. But we have to take into account that they are going to be used and sometimes I'm afraid abused by commercial institutions. And the second point is about security, in the sense of computer security, that we protect the whole database, not just from someone stealing the data, but also from someone modifying this data. And that, of course, could have really dangerous consequences. But I think that on these 2 points, we should follow some of the 2 advices that Bruno was saying about pragmatism and ambition. I mean, we have to make experiments. We have to study these things. We have a lot of new research results from mathematicians, from cryptographers that have been devised. The fact that we are using our credit card every day without even thinking of the possibility that someone else will steal our identities and will make purchases on our behalf. So we have to make experiment with these techniques on both personal data and on both protecting the whole computer ecosystem that we are using, but not that we get stuck, and so because of fear we don't make any step forward. So I do believe, of course, this is my opinion, that we have to go forward, experimenting, checking whether there are holes in the security, and considering that in these days we have to give up the concept of total or 100% security. So this is something that unfortunately doesn't exist. We cannot think that we can be able to work in this world without making use of new computer technology. But when we do that, of course, we have to take into account that there is a certain probability. We have to lower this probability, like, I don't know, 10 to the power minus 6, minus 7. But we cannot think that we can ever have a computer system or a database system that has a probability of breach that is 0. That's something that I don't believe. And the other things that I would like to add is that when we are thinking about these issues, we have seen a lot of sharing economies that are bubbling and are going out, like we have this Airbnb, we have many other sharing books or sharing taxi, whatever. So these things are growing, and these things are based on trust, because of course when we provide our credit card number to a tax company or to an Airbnb, we know that they are going to use it just for the purpose that we have asked them to do that. So, and of course we don't make any analysis of the security system of this system, but we use it. Just that we go there and we trust that we have enough security to keep going. So this is my consideration.
Okay, thank you, Giuseppe. So we mentioned about standardization is key, and big data world makes us to reach personal data, and confidentiality comes into view, and we have want to add Paul on those front.
So I won't repeat the excellent points that have already been made, although I agree with all of them. I'll add a couple of my own though. The first is, I think, a real challenge for us as a kind of community of central bankers is that a lot of the information we have is relatively recent. And we should never get fooled into thinking that we've got 5 terabytes of data, and therefore that's a lot. Because it might be a lot in terms of computer storage, but it isn't necessarily a lot in terms of giving us a good understanding of the underlying data generating process, the underlying mechanisms that we care about. So I do worry that we'll understand incredibly well the period since the last crisis, and our minds will be really focused on what happened in the last crisis. But actually, the things that we really should be worrying about might be somewhat different. So kind of sticking on the psychological theme, I guess. My sister's a psychologist, and she gets really annoyed with me when I make psychological claims, which I'm now about to do. So I apologise to her, and I apologise to you. But I do think there are 2 further worries. One is, in practice, working with large data sets can be a very time-consuming, messy process. There's a kind of good rule for thumb, which is that 90% of your time doing big data projects is spent cleaning the data up and organising it well, and only 10% actually doing the interesting analytical stuff. The problem with that is that you become wedded to the data, and you want there to be an answer, and you want it to be really convincing, and so you will actually see great things where actually it might not be that great. It's sunk cost, but we know as human beings it's very difficult to view sunk cost as something you should just ignore, even if our theory suggests you should. Linked to that, human beings are really good at coming up with explanations for things. So we did an investigation into the consumer price index. We used very, very granular data, so individual price quotes on a kind of geolocated basis, time-located basis. And we used decision trees and random forests to analyse this. And the people who were actually doing the analysis were not economists, but they just could not resist coming up with structural explanations for some very, to my mind, total random trees they were coming up with. So one was about plumbers and taxi driver rates after midnight. So it's that granular data. And they actually came up with a reason why this actually would indicate future inflationary pressures. And it just sounded complete nonsense to me. And this is what policymakers, senior members of central banks are really good at, is getting through the chaff and making sure they understand the wheat. But we, as data scientists, are going to do ourselves no favours if we come up with excessively convoluted, somewhat spurious reasons just because the correlations in our data say so. And then generalising that slightly, I know no one is suggesting this, but sometimes in the media people talk about artificial intelligence in particular and large data sets as being sufficient, that's all you need. And I'd say in the central banking context, it definitely is not. We need to have a coherent organising framework to think about what the information we're seeing is telling us, to frame it in a way that makes sense from a policy perspective, and to communicate it to the outside world, to all our stakeholders. Actually, one final point is I think there's a slight tension at the moment in our world between the desire for increased transparency coming from all of the issues facing us politically as well as economically, and the increased complexity of the data sets we use and the models we use to analyse those. And this is not obvious what that tension leads to, but I would say one thing it doesn't lead to is increasing black box models where we don't explain to our stakeholders what's going on inside.
Okay, thank you, Paul. So now it's your turn. We have discussed already opportunities, and plus we discussed the challenges as the theme of our panel indicates. Now
question every month. What is your rent? And we know that the rent never goes down, right? But when we collect the online data, we see that because our economy is recently cooling, we see that the house prices is actually going down. But we don't see in our statistical data. So there is I can see that there is a room that we can improve our inflation data with the online version, and it has a lot of implication for for policymakers, because if the house prices is going down, you need to do something to address this problem. If you can elaborate your talk on this one, would be excellent. And my second question is going to be to Giuseppe Bruno, and I know that you have a great expertise on the econometrics area, and since I joined to this central banking world, I heard a lot of talks around DSGE models, and we know that heavily failed during 2008, and our models are not doing well during the turbulence that we experienced. Do you think that this big data will going to help us to improve this kinds of modeling scope? I mean, just your opinion. I mean, is there any room to think about our traditional model is marrying with the big data? Is there any room for this one? And the final, I know that this difficult to find all these panelists at the same time. So my question to Jean-Marc is about EMIR, your derivative data set that you're collecting. It's good news from Turkey is that we passed the regulation, and then we're collecting all the EMIR's sessions. So we have the banks and the corporates are reporting this one. Do you have any experience with the anomaly detection in the EMIR form? Right, we have this derivative data, but there is an anomaly. I mean, maybe it's a speculation. It's not hedging purposes. Do you have this kinds of studies? And very final question to Paul Robinson. You mentioned about the importance of the cooperation that we learn from each other. We learn a lot from all your experiences. And Giuseppe mentioned about they have the conference in mid-January, another one in July. Actually, by coincidence, we learn this kinds of stuff. I'm not aware of any network of central bankers are coming together and discussing about machine learning and all this big data stuff. Do we have anything like this one? If there is nothing, maybe would be nice that you said about importance and you are leading the kind of network on this field. Would be excellent. Would be excellent to hear about what our colleagues are doing at the central banks and when they're coming together, so we can apply and attend as well. Excellent. Thank you very much for this session.
Thank you. So shall we take all the questions and then? Okay. Okay. Oh yeah. Zahid from Central Bank of Turkey.
Thank you very much. I will have a question to Paul Robinson. Almost 10 years ago, I was listening Greenspan, and he was telling our problem with the models is not they are too complex, but they are too simple compared to reality. So I think this is still true because even when we talk about big data, machine learning, it is essentially correlations, or deep learning, it is Kalman filtering or other filtering methods, and or forest trees. Most of them are simple methods. So can we think about like developments based on big data, like really heterogeneous agent models and behavioral individuals' behavior based on their past experience, etc. So maybe these kind of computationals will be more available, and I expect in the future such developments and maybe related to your Lucas critic, we will have a really interesting marriage between models of economies based on focused on causality compared to correlation. So I want to have your opinion and if there are from other panelists. Thank you.
One last question because we are running out of time and Jean-Marc will be leaving soon. So, do we have the last question? Yes, we have.
In terms of confidentiality, a number of people have addressed confidentiality of personal data. There's often, between jurisdictions, major issues about confidentiality of financial institution data. Most of the panel are European. Well, you're all European. Most of you work for European institutions. And these and obviously to understand global risks, one needs to put together that global information. How much of a barrier are you finding the confidentiality issues about putting together consolidated financial institution risks? Thank you.
So, thank you. So we can follow the same turn and start from you, Jean-Marc.
Thank you. I will mainly answer the question of Emir, but say a few words on a few other questions. On Emir, I think as said by Paul, and also I think by Bruno, it's 100 million new data per day, which means billions and billions, and our colleagues in financial stability for the time being do not go for individual information. What we do is that we have built up a kind of, let's say, prototype, and now we are making it more robust, which will be delivered next year, on having something like a few hundred indicators derived from EMIR. We have done a lot of cleaning, and Riyadh has helped, because one point which was made was, who is the counterpart? And Riyadh, at least in Europe, helped a lot to identify the counterparts. Whatever the identifier which are used, because in Riyadh we can have 10, 15 aliases. So we can use the information which is in EMIR to identify adequately the counterparts, and on this basis make a certain number of aggregation, also using other data, part of the data, other attributes, there are 80 attributes in EMIR. So the idea is that we take the data and that we build up a number of a few hundred indicators which are really focused on type of analysis at macro level. Some researchers are doing internally to BCB or externally, but in agreement with BCB, are doing some work on specific domains of it. But for the time being, it has not led, except to, of course, identify some anomalies, etc., but nothing really in terms of substance, in terms of analysis, which is really new out of it. Also, because of the size of it, and the difficulty to handle the data, which are not completely standardized, because you know that there are many trade repositories, and each of them has different standard, and now ESMA and FSB are trying to converge, but it's a lot of work and it's not yet achieved. So I think this is not, for the time being, the analysis is more trying to understand the correlations, trying to understand the interconnectedness and doing indicators out of them. On just maybe one point about real estate prices, we have had a recommendation by the European Systemic Risk Board, which is a board which is different from the central banks, but where you have central bankers and supervisors. And one recommendation which was issued in November 2016, so 2 years ago, was can we have more data on residential and commercial real estate, both the market data, physical market, and the funding. And we are working on it. And Anacredit will, for instance, still deliver data on the funding of commercial real estate. So the idea is to get a better idea, and I think I completely adhere to what Paul said. If you want, for instance, to identify prime versus non-prime in real estate, that it changes, it may change over time. So what you need to do is to have really very limited, very deep knowledge about the geographic location. So if you have transactions with your contract for the funding where you know where is the counterpart, where it is located very finely, then you can say, okay, it's prime or not prime. You can at least try to find out, and that helps a lot to say, okay, depending on whether it is prime center of the town, one of the big the dynamic towns, or whether you are in rural area, etc. You have different developments, and you can have different risks associated to them. So the idea is getting to this level of accuracy, and again, with granular data, at least on the funding side market, we should do the same, by the way, on the physical market, is to get to indeed identify, maybe not forever because it changes, but to get really accuracy on where you are dealing, because it's not the same, especially for commercial real estate, but to some extent also residential real estate, whether you have something which is becoming prime or becoming non-prime for whatever reasons. Thank you.
Thank you. Bruno, about house prices?
I cannot resist to take first the question for Paul. So international cooperation, I should promote more. So that's exactly what the IFC Committee of Central Banks that is hosted by the BIS is trying to do. So we have already almost 100 central banks in this committee, including the Central Bank of Turkey, and we really want, we don't have a lot of resources, but that's exactly what we want to do. So this workshop in January, we will co-organize with the BIS at the Banca d'Italia, and I think Murad from Central Bank of Turkey will attend. And in fact, every year, or around every year in the summer, we have big conference where at least around 50 presentations by central bank statisticians to central bank statisticians are made. So we try to promote this, perhaps we should do more. On your question on the CPI, no, I was a little bit provocative at the beginning. My point is that 5 or 6 years ago, you had people saying, oh, let's get rid of the traditional statistics, for example, to compile CPI, just look at the internet. And now, with the benefit of insight, we see that yes, it can be complementary, you can have additional insights. And I was saying that an estimate that I saw recently for the US is that 15% of the CPI compilation is using big data sources, but it's not 100%. But yes, you have very good work to have as a complement information derived from the internet to have this compilation of indicators. Last question from Rupert, as usual, is a difficult one. The only thing that I could say is the confidentiality of the data collection. It's really a big issue for us at the BIS. But one thing that I would like to highlight, especially to you at the FSB, is that there is a problem here because we collect data and we have to preserve confidentiality of this data because we want to share the data among the people that have to have access to the data. But because we are very restrictive, outside people, they don't see the use of the data. And sometimes outside people in the central banks. And then at some point they may question, why do you collect this data? So we are not there, but we have, even if the data are confidential, we still have to have a lot of work to explain why it's important to collect the data that perhaps you will never see.
Okay, thank you. And Giuseppe?
Yes, okay, so
Favor of
I will,
DSGs.
I will skip on the cooperation question because Bruno has already said something. And before answering to the modeling and forecasting accuracy question, I would spend a few words about confidentiality. Because in my experience, I can say that I found problems even in exchanging data with the same National Statistic Office. So I would say, and I think it's not something that is limited just to Italy. I think it's something that is an experience that is felt also abroad in other countries, that it's not easy to exchange data between institutions, even if they belong to the same country. One possibility that somehow we are exploring is the fact that sometimes it would be possible to at least allow remote processing. So even if I do not provide the whole data set, I provide the possibility to issue commands, statistical commands, to get averages or to run regressions. So that's something that we are already providing with some data sets, and I think could be a possible avenue for the sharing of data. So about models, you made a really first of all, I do believe that not just a failure of the DSG, it was a failure of many institutions not understanding the size of the crisis that was popping up. I mean, that's the point. Not just the DSG, but even classical structural equations. The only thing that I can say is that now we have tools to compare forecasting accuracy, and we can run competition on many different models, like the one that we see on these machine learning sites. And I think this kind of experiences could be a possible solution, because in the classical books we study asymptotic theory, so we know that at the end, toward infinity, some things will happen. But of course, we don't have infinity. We have a finite sample, so we have to do something with the final sample. So with the final sample, we can have different kinds of indicators. So we have different statistics that can allow us to compare the forecasting accuracy. That of course is not limited to DSG, because for example at Bank of Italy we run also a classical behavioral econometric models with many equations, but that doesn't protect us from events like that.
Okay, thank you. Paul?
Thank you. So on the models, I guess the two questions actually, the DSG one and your one are kind of linked. To quote Einstein, it's always good to quote Einstein, a model should be as simple as possible, but no simpler. And I think that's true in economic policy as well, that different questions require different sorts of models, and different models will perform well or badly. And indeed, I'd say on the DSGE point, there's nothing wrong with DSGE models, but I think they were overused, is my personal point, my personal perspective. I personally don't think they're very good forecasting models, but they are well set up for policy analysis in certain situations. On the kind of agent-based models, etc., we are definitely interested in those, and we've written a few papers on them. And there's a guy in my division who we hired from the physics community. He's an academic physicist, and he was using agent-based models to model the center of center of stars, with kind of 10 to the power of 20 agents, kind of ridiculous things. So I think that's definitely a potential gold mine, really, for economic policy, but it can't do everything, and we should have a very open-minded approach to using a variety of models, both statistical and more theoretical, depending on the situation. On cooperation, I totally agree. You know, we do want to cooperate more. This is fantastic on this. We run an annual kind of big data analytics conference, which took place last month, I think. Was it last month? 2 weeks ago. The more of this, the better, but I guess more coordination would be great, and more just talking to each other would be great. And then finally on the consolidated data, yes, we've definitely run into that issue, and I would echo the point that it's not just cross countries, it's also within countries. That's a big deal. You know, financial markets are global, and the fact that we've got national data is something of an issue.
Jean-Marc wants to add 2 sentences on confidentiality issues.
Yes, it's a relative notion. I mean, when we started Uncredit, there was one country, I will not say which one, where the credit register data were used only for prudential supervision, and even the prudential supervision had a very limited access to the data. When a researcher in that country wanted to have access to the data for any type of research, even anonymized, it was 6 months of administrative work. And Uncredit will have far more information and will be completely shared across all the domains in central banks and across all the Eurosystem, so at least all the countries in the euro area, plus with a reciprocal arrangement, also other EU countries. That shows that confidentiality is really an abstract concept which can be changed over time, because also the mindset may change. So it's within Europe, but I think this model shows. And the second example I wanted to give is Riyadh. The register is shared across the ESCB, not only Eurosystem here, ESCB, but also with supervisors. So we share all the information, almost all the information. There are a few subset of the information which are about the reporting, which is not shared, but all the rest is shared across the EU, and we are even ready to share it on a reciprocal basis with partners outside. So I think this is, and the Statistical Institute continue to consider that it is highly confidential statistical information, even the NES code, so the code or the ISIC code, which gives the industry activity.